Good morning, ladies and gents. My name's Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management. It gives me great pleasure to welcome you all to today's webinar. Thank you for joining us. If during today's presentation you have any questions, be our guest and do use the Q&A box at the bottom of your screens to submit them, as we've allocated time at the end of today's session to answer questions. If you have live match questions or questions that need a more detailed response, we'll make sure to follow up with you after today's webinar is concluded. Today, I'm joined by two senior members of Blackfinch Asset Management who will be providing you with two vital pieces of information shaping how advisory firms operate within the multi-asset space today. First, we'll be hearing from 30-year industry veteran and Blackfinch Head of Asset Management, Mark Keogh. With the introduction of Consumer Duty in July 2023 and the focus the FCA have placed upon advisory firms to properly demonstrate adherence to the cross-cutting rules and the good customer outcomes are being achieved, particularly with the recent Section 165 data requests that have been issued across our industry, we've worked with a number of firms who've been concerned as to whether the CIP they currently use is truly fit for purpose. So Mark will be taking through a series of 8 areas that we've identified which are common threads where a firm's CIP may be holding them back, either acting as something that's creating difficulties with service delivery, is becoming a burden on business resource and efficiency, or indeed its ability to properly satisfy regulatory requirements. Second, we'll hear from Gareth Deacon, Blackfinch Head of Multi-Asset, who brings with him 2 decades of experience in investment management. Now, over years, the argument of active versus passive has been an ever-present topic of discussion, with passive grabbing headlines for performance on their good days, whereas in comparison, active management has often been met with skepticism over its effectiveness to drive alpha whilst balancing volatility. So Gareth will be exploring the latest in the research carried out by himself and Blackfinch Chief Investment Officer Dr. Dan Appleby on how and where active management can be an exceptionally strong addition to an investor's portfolio when carefully considered and chosen correctly. Now, before launching into today's content, it's important for me to note that the details we cover for you today are intended for financial professionals only, and as such, they shouldn't be interpreted or taken as financial advice. And so I'll now hand over to Mark Keogh to begin today's content with the 8 signs your CIP could be holding you back. Good morning, Mark.
Good morning, Jordan. Thank you very much. And good morning, everybody. Thank you very much for joining us this morning. And as Jordan kindly said, I'm going to be talking to you about the 8 signs that your CIP could be holding you back. And just for clarity, here are the learning objectives for today's session. But I wanted to set the scene that this part of the presentation was born on some work that we've done with advisors, as Jordan kindly said, with the introduction of the Section 165 report. And I just read this morning that now we've got the 166, which covers pensions. A number of firms have contacted us to talk about their CIP and understanding a little bit how they can take control back to their centralised investment proposition. So the learning objectives today is a session for the next 20 minutes or so from me talking to you about your CIP and giving you some views and opinions from advisor firms that we've spoken to understand how their current CIP is structured and where they might be able to change or make it a better outcome for their clients and themselves as a business going forward. And as we discussed, we then pass on to Gareth. So thinking about, is your centralised investment proposition fit for purpose? Here are the 8 key signs that you may need to think about when looking at your current centralised investment proposition and how these 8 key signs could help support your business both now and moving forward to the future. So does your CIP feel like a black box? Advisors have said to us that one of the areas that they're not overly pleased about, and this is not for every single investment proposition. Remember, this is a broad brush approach across a number of advisors that we've engaged with, that they find that sometimes some of the investments they select just aren't transparent. They find that the level of detail that they get to understand the clarity around the performance journey their client's going on or the investment product solution that they've chosen is not actually giving them the full level of information that they need. And they want to make sure that whenever they're looking at the underlying investment they've selected for their client, that they fully understand the structure of that investment, what's held within that investment, and that they can explain clearly to a client what's driven the performance or the returns or the current structure, both at a regional or individual stock selection. It's not about having the ability to go into the full minutiae of all the details that the underlying investment company provides the IFA firm. It's more about just making sure that if a client wants to question you, that you do have a broad understanding, and that the information that the underlying investment company is sending you is fully transparent, and you do understand what's delivering alpha, or on the flip side, what's driving negative performance. Pricing's out of step. So I could spend an hour just talking about this particular point. So when we spoke to advisors, we all know about the race to bottom discussion. We all know price versus value, price versus service. But there is clearly a number of advisors that are looking at the overall structure of the pricing of their current centralized investment proposition, and just making sure that the value that the solutions and products that they're supporting are actually delivering the outcomes that they're signed up for. They're sometimes a little bit confused about the total cost of the service they're providing. Have we gone from a world where products are charging 2-3%? Yes. Are we now in a world where, you've got the whole debate of active versus passive, which Gareth's going to talk about more later? Are we going to go into a world where we're driving costs down to the absolute bare minimum? I don't think we are. From a Blackfinch perspective, we do understand the value in making sure that you can demonstrate the level of costs that you're paying for your service are in line with what your expectations are, and are in line with what the regulator's looking for. But it's just about getting to that point where, no one price fits all. And you need to be looking at your overall centralized investment proposition and making sure that you're getting value from that proposition, and it is delivering the level of returns and cost in line with what you're trying to achieve, by making sure that you are meeting the requirements under consumer duty, and later on we'll talk about a bit about co-manufacturing. So does your investment proposition adapt to market changes? Again, thinking about what we were talking to advisors about was the fact that when you outsource to an MPS, which a large chunk of the market is now doing, and we all know this market is now commoditized. I looked at some stats the other day. There's over 200 different MPS providers and solutions available in the market now. It still remains the fastest growing investment product solution in the entire industry across the UK. It's continuing to grow at between 13 and 15% per annum. And a lot of advisors are now using an outsourced service. But one of the things that some advisors are finding difficult to actually accept is the fact that they tend to go into a product and it sort of stays as it is. It doesn't actually move with the times. Rebalancing's done at a set day every quarter, month, or whenever the period is. And when the market has periods of volatility, advisors want DFMs to demonstrate the value they're bringing back to the underlying investment by, making sure they act when you have those volatile periods. It doesn't mean that you need to buy or invest in a partner that moves every time the market moves, but it's just making sure that your investment capability is not so rigid that it's like, we're not going to do anything because it's not the right time for us as an investment manager. You want to make sure that when the market does have volatile periods, that you're getting quick information, it's transparent, it enables you to go straight out to your client. It gives you an element of control back in the journey, and it means that whatever happens in the markets, that you are demonstrating to your client that you're adding value, and also make sure that the underlying investment partner that you're working with is actually demonstrating that they're adding value by moving and changing the portfolio in line with the market conditions, if it's relative to create better outcomes for your client, both either from an alpha perspective or protecting on the downside. Brand alignment seems to be becoming very, very key within this change for advisor firms. So one of the areas, I've talked about this before in other webinars. I do a lot of work with Heather Hopkins from Next Wealth Group. She and her team, I think, do a really good job at analysing the entire marketplace, and especially for my area of the marketplace, which is the discretionary side. And the two areas that I advise firms, from their perspective, based on analysis they've done in the market, that are going to be focusing on this year or moving forward, is control and CRP. Excuse me. I mean, the introduction of the Section 166 report, as I said earlier, that's following 165. There is a demand from the FCA and the regulator to ensure that your CIP and CRP are fit for purpose. And what do we mean by brand alignment? Some advisor firms feel that they're just being given the standard same off-the-shelf proposition alongside everybody else. And whilst there's nothing wrong with that off-the-shelf proposition, advisors are looking to make sure that their overall centralized investment proposition is aligned with their own corporate structure and values, making sure that when a client invests with the advisor firm, that the journey that the client receives is in line with exactly what the IFA feels and believes is the value of their business, and making sure that the investment partner that they engage with demonstrates that brand alignment to ensure that that filters through all of the advisory firm's businesses, rather than just having a standard off-the-shelf solution. So one of the areas is thinking about tailoring the journey from a collateral perspective, ensuring that everything that the client receives, everybody that's involved in the CIP, it represents the true value of your business. People refer to white labeling as a way to explain this. It's not about white labeling anymore. It's not about just putting a logo on your fact sheet. It's about tailoring the entire journey for you and the client to ensure that everything the client sees, everything the client reads, is in line with what you want that message to be from a brand and value perspective. Strategic decisions. This is one of the really hot ones. So a lot of advisor firms, whilst they do not want to be discretionary fund managers, while they do not want to actually have direct input or decision making, they want to be made to feel that they're part of the process. One of the areas that advisors spoke to me about is about the whole total cost service proposition, and making sure that if you're providing an investment centralized investment service, that you can demonstrate not only to the regulator, but more importantly to yourself and your client, that you are involved in the overall decision-making process. So they want to be in control, or at least to be given the opportunity to input into asset allocation, fund selection, or at least have an opinion and a view, rather than just being told, here's what you get, this is the standard solution, and that's that. Some firms think it's really important to demonstrate their target market value assessment, not just through the underlying product and cost charges, but demonstrating the value of the service they're offering back to the client as an overall arching support for the CIP or the CRP in that perspective. So having the ability to be included in the room rather than left out of the room is really, really important for some firms that are looking forward to make their CIP future-proofed for the, I just said future-proof for the future. And risk profiling is our next area that has caused a lot of concern for advisors. Where we are with risk profiling is everyone has to have it. We're all aware of the majors in the marketplace that provide these services. But what some firms are saying to us is that they feel that they're too restricted. You don't have the capability to change the asset allocation. You don't have the capability to move outside the tram lines. You've almost got this sort of, bold line where you cannot go outside any of the level of the risk profile, has to stay within that sort of 3 to 7 structure. And advisors want the ability, where it's relevant to the certain types and styles of clients, to make sure that they can have some input into the overall risk profiling and have the ability to maybe move outside the tram lines, to give the discretionary fund manager the ability to have a little bit more flexibility when it's relative. So where the discretionary manager feels he might be able to drive a little bit more alpha, or more importantly, where we need to take risk off the table, providing we're staying within the overall risk profile budget, is having the capability to be able to just be a little bit more flexible rather than having you cannot change this because you're stuck within this risk profile and there's no flexibility in order to move up and down within the risk profile. There are a lot of firms that feel the need to maybe have that little bit of flexibility, providing you stay within the risk profile, but being able to tweak those tram lines a little bit is something that they really think is interesting, and something that does show some actual value, added value moving forward when thinking about constructing their centralised investment and CIP propositions. I've seen this picture many times, so not one size fits all. You can't just force something in. You need to be able to have the flexibility to adapt and change. Are you relying on one provider? Advisors feel that certain firms, they maybe have, all their eggs in one basket. It may be that there isn't enough selection on the menu, that they don't have the option and choice or flexibility. It's almost like firms have gone from one extreme to the other. Some firms have a completely independent CIP that's open and broad, and you can buy any product solution you want. I'm not suggesting for one moment that's wrong. And then you've got the other side of the coin where some have restricted it so strongly that they feel they're sort of stuck. They've got a lot of money invested with one provider or maybe one or two providers, and they feel like they don't have a choice. They have to stay linked to that particular investment proposition. The menu doesn't have anything else on the list apart from that one provider. And maybe by using your annual review process and co-manufacturing and consumer duty, it's an opportunity for you to maybe think, I need to consider who I'm supporting, and maybe there's a chance that I need to diversify that risk and work with fund managers that can have a product that has the ability to diversify both globally, asset class, and any aspect, and not being stuck with that one provider that you feel that you have to sort of support, irrelevant of whether their product is right or fit for purpose or is in line with what the requirements need for the regulator today. How do you differentiate yourself from the competition? So we've talked about, the off-the-shelf solutions. We've talked about the fact that the market is growing substantially. We've talked about the fact that a large chunk of the advisory market is now outsourcing and using MPSs and discretionary style services. But how do you differentiate yourself from the competition? How do you make your brand stand out in order to show that for you and your clients that you are something different? How do you create a process that one could deem as unique? How do you build a proposition that no one else can replicate? And there is a solution. There are ways that we can help support your business do that. But how do you stand out from the market? So just to summarize the 8 points, relying too much on one particular provider or provider, your pricing maybe is time to review your pricing. It's time to think about the cost of the service you offer you and your clients, and what the investment partners you've chosen to support are charging you, to make sure that the total cost of the service you're offering is in line with what you expect it and what the regulator would expect it to be. Having the flexibility to adjust your risk profiling, thinking about brand alignment. How do you differentiate yourself from the competition? What can you do to make yourself different? Working with a partner that perhaps has the opportunity to adapt when the market changes and volatility comes through the markets. You currently don't get included in decision-making process. You want to have, you want to have more involvement in strategic decisions, and most importantly, that, you want things to be transparent. You want the ability to be able to sit in front of your client and show all the aspects of your CIP, and making sure that the investment partners that you've chosen with deliver all of the requirements to help you stay in line with what you're looking to achieve in the longer term. What I wanted from this section is to say to everybody, look, if you're running a centralized investment proposition, hopefully the 8 signs will show you that if you're ticking all those boxes and they're actually delivering, and you're actually delivering all the areas that we've talked about, which is obviously from speaking to advisor firms that came to us on the back of the 165 report, If there's anything in what I've just talked about that sits with you from a maybe it's time for me to think about that, or maybe it's time for me to look at that. If there's two or more areas inside this presentation that you feel that as a business owner or as an advisor or anybody who's connected to the investment proposition, maybe it's time to think about looking at your CIP or your CRP and thinking about what you want from your investment partner moving forward. So at Blackfinch, we have and are running a tailored portfolio service. In my mind, this is the next level of MPS. This is for the advisor firms that are looking to future-proof their CIP now and for the future, creating more value back in their business, and most importantly, bringing you and giving you back the control that you deserve. So what is a TPS? Why should you choose it? And how does it work? So advisors no longer see value in MPS. It's still a massive product and it's still taking an absolute stack load of money. But they're looking for something more now. They're looking for more control. They're looking for more value. They're looking for more transparency. The continued increase on advisor firms for regulation is not stopping. We've mentioned the 165 and the 166. I'm sure there's more to follow. And a large part of the market is now already outsourcing. So most firms, I'm hoping that are on this call, are either already using some sort of outsourcing service or definitely considering it. About 2 years ago, we created a discussion paper, which was called Bringing Value Back in Your Business. This was really designed for advisor firms that are thinking about selling and thinking about how their business is valued today, how other parts of the value chain value their business, how much money the value chain makes more than advisor firms, and thinking about how you can create value for you and your clients, and more importantly for your business now and for the future if you are considering the acquisition trail or an exit strategy. I'm not going to talk about this for long, other than to say if anyone's interested in understanding a bit more about that process and how we can help support that, please make a request for the discussion paper, and we'll be more than happy to send it through to you. And again, if you want to have a chat with us on a one-to-one with a bit more detail about that, it's really, really, really is a good read, especially if you're thinking about an exit strategy for your firm and you can see how you're valued against how other parts of the value chain, like asset managers, acquirers, consolidators, the amount of money that they make. And really the person that should benefit the most from their client bank overall is you as the advisor in the firm, not other companies or distributors in the value chain. Well worth a read. So what does TPS offer you? So I mentioned earlier in our presentation about white labeling. I think white labeling is a bit old, if I'm honest now. I feel that what advisor firms are looking for is really a truly tailored approach. It's having the capability to work with a DFM that you can create a proposition or a solution around what you want for your business and your clients moving forward. It isn't about us telling you what we offer and you fitting in around us. It's about us helping you decide what your asset allocation wants to look like, making sure that we can create a pricing structure. Within this service, there is no pricing structure per se. It has the ability to be priced at any price point that you want or you would like. Of course, there's caveats to that as Gareth will talk about a bit later. Active versus passive. The more active you have, the more expensive, the more it costs. Obviously, the more passive you have, one could ask, the more cost effective it becomes. But having a blended approach, so you set the pricing model, you tell us what you want the cost of the service to look like. And I don't know if there's many firms out there that offer that level of flexibility where we can work with you on the asset allocation, the fund selection, and we can create a pricing point which is exactly in line with what you want to achieve, which absolutely ticks the regulation box at every single level and future-proofs the cost of your service moving forward. And if the market changes and adapts, we have the capability to adjust that even further if required. Having your own investment committee, part of the regulation requirements under Consumer Duty and Co-Manufacture is making sure that you complete your value assessment, your target market, your client segmentation, and making sure that you have a service in place where we provide you with all the due diligence that you need, that all you have to do on an annual basis is just provide that annual review. Everything else is done for you. You have your own investment committee, which we sit on. We can decide the structure, how it runs, what information you want within the investment committee, and all of this is documented and sent out to you to make sure you can put on file to protect you and your clients from a regulation perspective. Communication and literature, we have a whole suite which I'll show you in a minute, just some of the areas that we can help support you on. Don't have to have it all. You can have whatever you want to help you and your clients make sure that you're achieving an investment proposition that's future proofed. Risk profilers, we can map to any risk profiler you want. If you want to talk to us about having some flexibility within the risk profile, you might have a particular client or a high net worth range of clients that want a special type of investment, that want to have 100% active invested in, India, for argument's sake, or you want some sort of specialty income solution. We can adapt and work with you in order to build whatever solution you want. Unlike other groups, you have direct access to the fund managers. So when you want to phone them up, if you want to talk to them, if you want to get something relative to the market, you want a question from a client where you need a quick answer, we do not have a controlled function where you have to go through salesperson to sales support to analyst to fund manager. If you want to speak to the fund managers, you have direct access to them. And of course, we'll work with you to create collateral and thought leadership pieces that are in line with what you want your clients to read rather than what we're telling you to read. So, it's all about creating a proposition that's unique to you, and you drive the content, you drive what's in it. We deliver it for you, but the structure and how it looks, the brand alignment, all the areas we talked about in the reviewing your CIP, we work with you to help design that proposition. Here's an example of some of the collateral that we can create for you. It's not an extensive list, it's just an example, but the whole point is we have client-facing, advisor-facing, professional client-facing literature. The idea is we work with you, we create a range of tailored pieces that enable you to be able to help design that brand alignment in line with your own values, and making sure that the information you send your client is relative, transparent, and topical. So what does TPS allow you to do? Gives you the opportunity to take back that control. It enables you to help influence, design, and create a unique range of models that could be priced at any point, and hopefully, more importantly, create value to your client and tick the box from a regulation perspective to make sure that you've got a business that can create value for you, future-proof your business from an investment proposition perspective, and give you something that stands out from the crowd. We can show you how that you can protect value in your business by creating a TPS. I talked to you about the discussion paper we've created earlier. That's in line with talking about that and how we can help you create that value for the future. But more importantly, it makes us work for you rather than you work for us. I think it's really, really important that advisors take back that control. It's not becoming a discretionary fund manager. I want to make that absolutely clear. It's about making sure that the investment partners that you choose to work with deliver what you want for you and your business and for your clients, and making sure it's in line with the regulatory requirements that you need now and what you may need for the future. So I'm now going to pass over to Gareth to cover the second half of this session. Thank you very much for listening, and I shall now pass back over to Gareth to cover the evaluating your portfolio strategies.
Thanks, Mark, and morning, everyone. Thanks very much for joining us today. So as Mark said, I'm going to talk a little bit about how we approach portfolio construction as part of the tailored portfolio service. As Mark's made very clear, I think at this point, this solution is built for you, to your requirements. It's not for us to tell you what your investment solution looks like. It's for us to work with you to ensure that the investment solution that we build for you meets your requirements and the requirements of your clients. So it enables us to say, look at cost point, asset allocation, blending active passive, numerous parts of that. But one of the things that we have to do at all times is make sure that whatever solution we build for you is the most efficient and effective range of portfolios that we can deliver to meet any cost budget that you require. Now, as a team, we have a pretty broad range of backgrounds, from those with mathematics backgrounds, scientific, retail banking, bespoke private client. We've got those in the team who've come through CFA qualifications, those who've come through the CISI. it means that everyone within the team looks at the world a slightly different way. And we think that's vitally important for us as a team because it enables and encourages challenge amongst the members of our committees and the members of our wider team. Just as importantly as challenging each other, we like to challenge ourselves. We know the world is constantly evolving and we need to ensure that what we believed yesterday still holds true today. And therefore, we want to constantly challenge our views around active and passive because the world has arguably changed, certainly in terms of the weight of capital that's moving towards passive investment in the last probably 5 to 10 years now. And so challenge that argument of, is there still a place for active funds in multi-asset portfolios? And if there is, where is it? Where can we still find that value? Now, I've been in the industry for nearly 20 years, as Jordan said at the start, and there are things that I learned on my first day in the industry back in early 2006 that still hold true today. And there are those that I've had to learn to let go of. But it's only by constantly challenging that thought process and not getting bogged down in a legacy investment process and legacy investment style that we can make sure that we're moving with the times and making sure we're at all times, as I said, building you a solution for you and your clients that is as efficient and effective as possible. Now, one of the key methods that we have to use to control that cost is obviously the way we blend active and passive management. So when we were discussing as a team how we should best approach this, we decided to set it out like an experiment. Essentially, we love data. As a team, we love data. We're not a quant house by any means, but we do love the power that data can give us in helping us to implement investment decisions. So if we're going to set this out like an experiment, like a proper old school science experiment, if you remember back to your school days, one of the first things you have to do when you set an experiment is you have to set your hypothesis. You have to set what your belief is around what you believe the outcome is going to be before you start. So we thought about why we think there's value in active management. Why do we, historically, why have we used active management in portfolios? Where do we believe it can still bring value? We came to essentially two key points. The first being there's informational inefficiencies, or we believe, prior to this experiment, there's informational inefficiencies in small and medium-sized companies that provide the opportunity for price discovery. So perhaps there's more value to active management in mid and small cap equities. Secondly, the use of actively managed liquid alternative strategies. Now, that's a very woolly way of saying that the likes of hedge funds, absolute return funds, equity long short, all those kind of non-equity and bond investments that we can use in your portfolio to provide diversification. Now, the reason we believe there's value in those in active management is they're not the kind of strategies that can be implemented passively. So if we're going to use them in a portfolio, we're going to have to use them in an active way. So this is a hypothesis, but we then wanted to drill into why. Why do we believe that? Why do we believe that first case, specifically around this informational inefficiencies point? So we looked at two stocks, two UK listed companies, to test whether or not we think markets are efficient when it comes to their pricing of these companies in the market. The first company we took was Royal Dutch Shell. I would sometimes say largest listed company in the UK. That's kind of constant battle back and forth between themselves and HSBC for that title. But a company that's £157 billion market cap. They trade nearly £130 million of stock a day, and there's currently 25 sell-side analysts. That's just on the sell side. Obviously, we've got other analysts as well working on that company at all times, meeting the IR teams, seeing the CEO in the same media controlled environments, looking at the same reports and accounts, and broadly coming to the same conclusions. If you look at the price targets from those sell-side analysts, there's not going to be a huge amount of diversification there. There's not going to be a huge diverse view on the fortunes of Royal Dutch Shell, and therefore that's going to potentially mean that the share price is a fairly efficient representation of the position that company is in the market at this point in time. If we look alternatively at Lecheco, this is a small cap UK small cap company that's actually held within one of our actively managed UK stocks, UK funds that we have on our buy list at the moment. They have a market cap of only 230 million, so only 100 million more than the daily volume traded in Shell. There's £256,000 worth of stock traded every day broadly, and only 3 analysts covering. Now, we think from that perspective, just at a headline level, that suggests there's potential for more inefficiency in that price. There's not so many people going through the reports and accounts of that company all day, every day. Perhaps they don't even have an investor relations team. Perhaps the CEO and the CIO that the analysts are getting to meet maybe aren't as media trained to within an inch of their life to be guarded as to what they allow out in these meetings. So a skilled analyst may be able to actually find some information in there that would lead them to the conclusion that the current market price is not an effective representation of the company's fortunes. So that's why we believe that to be the case. But let's test it. Let's test whether or not that is the case. And again, if we think back to when we were doing science experiments at school, right, we set our hypothesis, then we make sure we've got a fair test. This is where it came to making sure that we carve up the unit trust market, the OICs, CCAVs, and everything that falls within that IA UK sectors accurately to make sure we're making it a fair test. So while we do use the IA as a starting point when it comes to our sectors, it's not the be-all and end-all. We don't take their word for it when it comes down to what funds we should be looking at when in terms of benchmarking. So if you look at the top two boxes, these are essentially the IA UK all companies and the IA UK smaller companies, the two key total return UK equity sectors in the IA. We're going to ignore the UK equity income. That's a separate topic. We can come on to talk about income and such like if anyone has any questions about that. But let's look at those funds. We've got 265 funds in here if we group the two together. But actually, they're not necessarily carved up that way when we're going to test the ability of those active managers to generate alpha. Let's carve it up ourselves. Let's look at what we believe to be UK large cap, and let's look at what we believe to be UK mid and small cap. So for this, we're going to use the Morningstar style box, that 3x3 box that you'll all be familiar with, I'm sure, that takes you from growth to value and takes you from mega cap all the way down to micro cap. Let's look at anything that falls in that top third. So the weighted average holding within that fund is in the top third. So it sits in the top 70% of market cap in the UK. Therefore, we should probably be testing that against the FTSE 100. Broadly, that's about 70-75% of the market cap in the UK is the FTSE 100. So let's test those managers against the FTSE 100. And then let's test the rest of them, the bottom 30% against the FTSE 250. Let's see whether those managers can generate alpha against those benchmarks that we're setting, rather than looking at the sector that they've chosen to put themselves into. Let's get straight to that. The fund house chooses which IA sector they want to go into. Obviously, they have to meet some criteria, but they're under that control, and they also choose their own benchmark. We could argue we could be cynical about that sometimes, but let's not for this case. But let's just say if we're going to test it, we're going to pick our own benchmarks for these managers. And let's look at how active management has performed in these two sectors. So over a 5-year period, we're going to backtest the performance of all of those active managers, all of those 65 managers that we think it's appropriate to test against the FTSE 100, and we're going to test it over 5 years, up to the end of 2024. We run this data every year, and we'll talk later about how we extend this over years and come to other conclusions that we can use in the management of your portfolios. But the way to read this chart is that zero line right down the middle. That's the performance of the FTSE 100 over that 5-year period. Cumulative performance. We're not talking discrete here. We're not talking about individual calendar years. We're talking about the cumulative performance over that 5 years. Everything to the left of that, every manager who sits to the left of that centre line has underperformed the FTSE 100 over that period. Now, we've grouped these together, so as you move from centre to further to the left, you'll see the managers that have underperformed by a cumulative 0 to 5%, 5 to 10, 10 to 15, etc., until we get to the 6 managers who've managed to underperform the FTSE 100 by over 25% over 5 years. There's a good chunk of that market that is underperforming. In fact, actually 15 of them, so 15 of the 65 have underperformed by between 0 and 5%. Now, I'm not saying this is the case for all of them, but if we were to look at the data that leads us to that output, there's a good chance here that we're looking at essentially quasi-trackers. We're looking at fund managers who don't have a large active share, who aren't taking the appropriate level of, I'm going to say risk, but that's probably not the right decision, active decisions to justify paying them active budget. So in a 0 to 5% of underperformance, you could probably argue there that you've probably received FTSE 100-like returns, and the only thing that's led to the underperformance is that paying for the active management. So the only people making money in that situation, you could argue, is the fund house. If we look to the right-hand side of this, what you'll see here is actually 7 funds. Now, only just over 10% of all of the funds that we think it's appropriate to test against the FTSE 100 have generated an active alpha over that period. And 0 to 5, 5 to 10, 10 to 15, that's good quality returns, but there's one manager there who's generated 20 to 25%. Now, as a team, we spend a lot of our time meeting, analysing, going through the DD of, and constantly challenging fund managers. But am I egotistical enough to tell you that 5 years ago, that's the exact manager in the UK out of 65 that I would have chosen? I'd like to think I would have had a good chance of that being the case. But do I have the confidence if I'm going to spend active budget and a limited amount of active budget, as we're talking about with a blended portfolio, to try and find that needle in a haystack? Potentially, if that's what you want us to do, because these are your portfolios, but as we say, but we think there's better places to be spending that active budget. Let's look at the same data for those managers against the FTSE 250. Here you'll see what looks like essentially a fairly uniform distribution, an inverted U-curve almost, in terms of the split between those that have generated alpha and those that haven't is actually pretty much 50-50. So it gives us a lot more opportunity to find a manager who's going to drive alpha in that sector. And maybe this does prove that hypothesis that there is informational inefficiencies in mid and small cap. At a pretty broadly 50-50, if 5 years ago you'd taken a dart and thrown a copy of the FT, you'll be glad to hear that isn't how we pick funds, but if it were, we would have had a 50-50 chance of finding you a manager and spending active budget on a manager that would have generated you alpha. And not only is this inverted U-curve, but actually if you look to the far right, there's 13 managers there who've generated more than 25% of alpha over that 5-year period. So purely probabilistically, we've got a good high probability of finding you a manager in that sector. And through our processes, we think we can find you those managers. This is where we're going to spend more of our time finding the managers who can generate alpha for you in that space. This isn't an argument over is it active or passive. It's a case of where is it active and where should we be passive. And that's what we think this research is going to lead us to a conclusion of where we believe it's most effective to use active management. So let's move on to the second part of that hypothesis, the use of liquid alternatives, the benefits, diversification benefits of using liquid alternatives. Now, as said, these are your portfolios. If you don't like funds of this type, we're not going to force you to have them in your portfolios. If you want an equity bond portfolio, that's absolutely fine. We're just going to show you this is what we believe. We'll have a discussion with you. And if the outcome is that you have had bad experiences in the past with funds of this type, and there's no getting away from the fact there has been some significant issues with funds, certain funds in this sector in the past, then we won't bring them into your portfolio. That's absolutely fine. But if we are going to, we need to make sure they're doing what they're supposed to do. We're taking away the risk of it being one of those funds that has issues, and making sure we're generating the diversification that we want. So what we're looking at here is the correlation of certain sectors and certain funds against the MSCI ACWI, the All Countries World Index. So in this case, our proxy for equities. Now, two of the key sectors that a multi-asset manager would go to when they're looking for bonds for your portfolio will be the IA Sterling Corporate and the IA Sterling Strategic. Now, I'm not going to expect you to understand, to know the definitions of what IA mean when it comes to the sterling corporate bond sector, but essentially that is any bond fund. Doesn't have to be a sterling listed bond, but what it needs to be is essentially any bond manager who hedges their currency exposure back to sterling. So you could have a fund in there that's 100% US bonds, but if they hedge their currency back to sterling, it means they can go into that IA Sterling corporate bond sector. If we look at the correlations here, actually over 3 and 5 years, you'll see relatively high correlations. Now, in terms of interpreting the data here, a correlation of 1 means two funds are exactly correlated to each other, two fund sectors or whatever it is we're looking at. So a correlation of 1 means they move in the same direction at the same pace. Anything down to anything below that is essentially the same direction at a slightly reduced pace. A 0 would be completely uncorrelated, and then all the way down to essentially a -1, which would be complete negative correlation. So completely the opposite direction, but at the same pace. So let's look at those 3-year and 5-year numbers. We're looking at bond markets here that the textbooks would tell us are giving you diversification in your portfolios, but actually what's happening here is you're looking at sectors that are over 70% correlated to equity markets. Now, unfortunately, we don't have to look that far back to 2022, which I'm sure we'll all remember was a time when equities and bonds fell in lockstep. During times of market stress, correlations move towards 1 in certain sectors, and therefore are they going to give you the diversification you need when you want it? In that case, we think there will be times when they will and there'll be times when they won't. So let's look at the targeted absolute return sector. Actually, the numbers are just as bad over 5 years, in fact, worse over 5 years. So as a sector, that sector hasn't been great either. But if we spend our time looking for those managers who can provide us uncorrelated returns, we think there's some opportunities. We think we can find them. So there's 2 funds here listed on the thing. These are not fund recommendations. Please don't take these as fund recommendations. All that's obviously covered in the important information at the start. But what you'll see here is 2 funds that will give you some lower correlated returns. So Premier Might and Tellworth UK Select there. That's a UK equity long short. Not negatively correlated, massively negative correlated, but uncorrelated. And that's what we're looking for. We're not looking for negative correlation, because all negative correlation is going to do is dampen your returns. We're looking for funds that can provide returns in a different way, uncorrelated returns. So Premier Mike and Utel, with you said, in that aspect would do that. Something close to zero is what we're looking for in this kind of table. Janus Henderson absolute return over 1 year has obviously done that. Over 3 and 5 years has been a little bit more correlated to equity markets, but it's also about understanding how that fund's going to operate. So actually, if I was to rerun this data, but the correlation versus the Bloomberg Global Ag as a proxy for bond markets, you would find that Janus Henderson absolute return is uncorrelated to bond markets. So therefore, we've got to understand that if we're going to build you a low-risk portfolio, where the bulk of your portfolio is bonds, we need an alternative that's going to be uncorrelated to bond markets. If we're going to build you a higher risk portfolio that's predominantly equities, we're going to need a fund that is uncorrelated to equity returns. Essentially, what I'm trying to say here is that we're not going to use the same funds in every portfolio we build for you. We're going to make sure that every portfolio rather, is built on its own merits, and it's built to hit its own its own investment objectives within its risk budget. Let's back test some of this data just to see if this actually rings true. We'll build 3 portfolios here, 1, 2, and 3. The first one being fully passive, 70-30, FTSE 100 and FTSE 250. That portfolio 2, we're going to take that 30%, we're going to put it in a mid-cap fund. And in that portfolio 3, we're going to take 10% of that FTSE 100 weighting and put it into an alternatives fund. And then we're going to back test that over the same period to see what the data looks like. From a purely return perspective, what we see is what the hypothesis essentially suggests that we should. It suggests that here, over that period at least, we've seen fully passive portfolio being the lowest return. We get that little bit of alpha, and this is all obviously net of fees, so ignore the fact that we've paid slightly more for these portfolios because of the use of active management. We get a little bit more alpha by bringing in that active management, and then we get a little bit more again by bringing in 10% of an alternative fund. So that's the returns, but returns aren't everything. Risk-adjusted returns are arguably more important than pure returns. And this is what we see when we look at the scatter chart. So this is your volatility against performance. So that bottom right there, that's your fully passive. We move slightly up and to the left when we bring in active management into mid-cap. So we get a little bit more return, but we get it at less volatility. And then if we bring in an alternative, we go again up to the left. So this is where you want to be when you're looking at these kind of portfolios. You want to be up and to the left. You want to be getting the highest amount of performance. This is annualized performance we're looking at here. The highest amount of performance for the lowest amount of volatility. So we think this proves the hypothesis. But importantly, only in the UK. Now, we could stop there and say, yes, we're right. Our hypothesis was perfect. We're not going to do that, right? As I said, we like data. We like challenging ourselves. We like making sure that what we believe is still holds true, and challenging whether that will be true in the future. So let's extend it to every sector, every appropriate IA sector. What you see here is every sector that we targeted, that we tested in that same way, the number of active funds and the benchmark that we used. Now, what you're seeing here, this is just equities and bonds. There's certain sectors that we exclude from this: property, infrastructure, target absolute return, because they're not a group of funds that are similar enough to test in this way. There's not necessarily an appropriate benchmark for it. So we test those in a slightly different way, which we can happily talk about if you want to extend this conversation. I'm just going to let you eyeball this list just for a minute before we flick to the next chart that will show you the output. One of the things I'm going to ask, if we were all sat in the same room together, I'd ask people to see if they were brave enough to put their hands up. But you've got the benefit of being behind your screens today. So I'm just going to say, eyeball that list and have a think about which sector here you think, when we tested this data over 5 years to the end of 2024, which sector did 100% of active managers generate alpha over that period? Now, I'll tell you that only 2 people, when I've presented this live, only 2 advisors have ever got this right. And I'll be honest, I wouldn't have got it right. I'm not sure that anyone in our team would have got it right. This is an interesting one, right? So let's look at, when we flick to the next chart, who it was. Now, if you say UK gilts, give yourself a big pat on the back. Congratulations. You are one of the very few who managed to pick out the UK gilts as where active managers have been really successful over that 5-year period. But the way we read this chart from left to right is essentially the probability of a manager of the average manager outperforming or underperforming. So we go from the far left, which is 100% of active managers generating outperformance, up to the far right, where we find that UK large cap, where not active management in the last 5 years at least hasn't been great. And we see everything in between here. I mean, there's some interesting things here, and I'd love to talk about this data in more detail, but we're pushed for time today, so I'm just going to give you the kind of headlines. We see some interesting things here. Bond markets, actually, sterling corporate bond, global mixed bond up towards that left-hand side. But then we get into the equity mid and small caps. UK mid and small cap, as we said, sat right in there in the middle. Over to the far right, where managers haven't been successful, weirdly high yield. Now, that's one that, again, not necessarily what we expected, but when we dug into it, we understood why. And if we'll just flick back to that gilts point, if anyone did pick that, I'll just give you a little bit about why that is the case. This is essentially a challenge I set one of our analysts to, which they weren't overly happy with me for, but to go and look at every active gilt manager out there and tell me why they've outperformed or underperformed. The reason is, essentially, gilts had a terrible 5 years up to the end of 2024. Any active manager who was holding anything that wasn't gilts in their portfolio meant they generated additional return, and the IA gives them that flexibility to hold a little bit of something that isn't gilts. Secondly, these are unitized funds. They have to hold a small amount of cash on their balance sheet for kind of efficient portfolio management to deal with inflows and outflows. And just by holding a little bit of cash, they didn't fall as much as the market. So it's the nuances of this data need to be understood to make sure that we don't look at this and go, oh, right, everyone, pile into UK gilt active manager because it's really worthwhile. But we think this gives us some sort of framework, but it's not the be all and end all, right? It doesn't give us everything we need. We also need to look at the next slide. And the next slide is, when managers outperformed, how much on average did they outperform by? And as you'll see, gilts has gone right from the far left to the far right here, where actually, whilst they've all outperformed, they only generated about 3% of alpha over that 5-year period. So what we need to find is the managers where there's a high probability of them generating alpha. When they do generate alpha, they do so at scale. And those managers that we have the confidence in being able to do that consistently. So there's numerous parts that go into it, but I just hope this gives you an outline of how we think about the world, how we consider the use of active management and passive management, and how we can blend that to create a range of efficient portfolios for you. But that's just 5 years. That's just the last 5 years. And then we need to extend that back a little bit. If we believe the last 5 years is going to be exactly like the next 5 years, then we could just stop there, right? But we don't, because we don't necessarily, while markets, don't repeat, they do rhyme, and that phrase you've probably heard from a lot of people over the last few years. We need to look at what's happened in the last 5 years and what we think is going to happen going forward. So this is essentially developed market large cap equities, US large cap, UK large cap, Europe and Japan, and the probability of those managers over every rolling 5-year period back to 2000. So the far left shows you the period of 2000 to 2005, and it shows you all the way up to the data that I've just shown you in the last few minutes. So what it essentially shows here is US large cap has never been a rich hunting ground for active managers. It's one of those statements you always hear, isn't it? No one can consistently beat the S&P 500. This data suggests that actually there might be a few out there, but that outperformance isn't consistent. Whereas actually in some of these other sectors, predominantly the UK large cap, which as we've just seen has been the worst over the last 5 years, actually in that middle period there, 2013, the period's ending 13 to 17, actually periods between 80 and 90% of UK large cap managers were outperforming. So what was the market like then that allowed that to be the case? We were in zero interest rates, we were in cheap borrowing, we were in relatively benign markets. Obviously there's periods of volatility, but if we believe that's the kind of environment we're going back into, that's where we should be spending our active budget. But actually what's happened over the last 5 years is that it's become all of these lines are trending downwards. So in every situation, we find that outperforming in this kind of market environment that we've seen in the last few years has become more difficult for developed market equities, large cap equities. But where has it gone the other way? Where is it becoming better? Where is it becoming not easier? That's not the right. Where is it becoming a more rich hunting ground for active managers? So you'll see the pulled out 3 here being North American small cap, UK mid cap, and sterling corporate bonds. And probably the most interesting here is that sterling corporate bond line, that blue line that goes from a period, interestingly, the same kind of time that UK large cap managers were generating a lot of alpha, sterling corporate bond managers were having a terrible time. Actually, less than 10% of managers were generating alpha. During that zero interest rate environment, during that low volatility, active management, the ability for a manager to drive alpha through credit selection, through duration management, they had a lot of their tools taken away from them, really, by the environment we found ourselves in. But as soon as we've been in this period of inflation and interest rate expectations and all of this kind of environment that we've seen over the last few years, that volatility has allowed active management to shine, and therefore we're now in a situation where it's, excluding UK gilts, the most richly hunting ground for active management. This is all data that we can lean into when it comes to effectively and efficiently building your range of portfolios to make the best use of your cost budget at any time. And we'll lean into this. We'll have conversations. We can use this data to say this is the environment we think we're coming into for the next 6 months, 12 months, 2-3 years, or whatever it may be. Therefore, we're going to take the active management that we were spending in this sector and we're going to shift it. We're going to shift it because this is where we think active management can be effective. Now, how do we implement this into a portfolio range? This is just quick in terms of reading this chart. The 100% that you'll see isn't the full portfolio. Please don't think we're only using 5 sectors within your defensive, your risk level 3 portfolio. This is essentially how we carve up the active budget. So the other key thing, really, to come back to what I said earlier, is we're not just going to use the same funds in every portfolio. We're going to build every portfolio differently on its own merits and make sure that we're making the effective use of that budget at every time. Now, I appreciate I'm very pushed for time, so I'm going to stop there, but I say happy to talk through that in more detail. But just to say, we're going to use different sectors, use that active budget differently across the range to be as effective as we can at deploying any cost budget that you allow us in the build of your TPS range of portfolios. I'll stop there. I see we've got a few questions come in, so with 5 minutes ago, I'll hand back to Jordan.
Thank you very much, Gareth. Now, as promised, we'll take a bit of time now to work through a couple of the questions you've kindly sent through to us. So we have a question here that I think is best going to be directed at you, actually, Gareth, if I may. Want to know, are you able to help us develop income models for a CRP proposition that can sit alongside our CIP or other model ranges that could have different mandates when needed?
Yeah, absolutely. And I've spotted there's a question that we've come in about ethical, responsible, sustainable. So I'll just kind of group all this together in one if I can. Income models, absolutely, we can do that. We run some income models for clients at the moment. We know there's a lot of discussion around there about what a CRP should look like at the moment. There's a lot of firms coming out with a lot of different solutions. Essentially, if we were to build you TPS portfolios and say, we're going to listen to you as to what you want to build you your total return, accumulation solutions. But when it comes to CRP, this is how we think you should do it. That would kind of go against everything we've said in the last hour. So what we're going to do is we can listen to what your requirements are. If you want natural yielding portfolios of different target yields, of different risk levels, we can do all of that kind of thing as part of the same process. If you want us to go down the route of saying, I want that bucketing approach, long-term accumulation, middle being the lower risk, and then a cash portfolio, all of these are the kind of things we can do. But what we're going to do is we're going to have that conversation with you, because not one range of decumulation solutions is going to be right for every advisor. So as part of the solution, we can have that conversation with you. And just to pull in that kind of sustainable and ethical question as well, we have our kind of sustainability, ESG, whatever phrase we are or aren't supposed to use right now to describe that. We have our processes when it comes to fund screening. We don't have, as part of our MPS, we don't have an off-the-shelf sort of sustainable, responsible range of funds. We can look to build that for you if that's what you need. If that's the requirement that you have for your client base, we can have that conversation. And if that's what you need, we can talk you through our current processes. It may be that they meet the requirements for some of your clients, but maybe the darkest of green clients, if we want to phrase it that way, there might be some additional screens we need to put in place. Maybe we need to look at negative screening rather than positive screening. We can talk about all of those kind of things and build something for you and your clients that's going to meet your requirements.
Thank you, Gareth. And I think we might have time for possibly one more. Mark, I think it's probably best directed to you. How does the tailored service support me with consumer duty and co-manufacturing regulations?
Thank you very much. You posted that question. That's a really good one. Okay, so my answer is this. If you think about back to the 8 CIPs and the warning signs and whether it's time for you to review your CIP, and advisors are looking to take back control, one of the things that I believe that's really important is making sure that the investment proposition that you support meets the regulatory requirements. And what TPS can do for you is we are a co-manufacturer. So when you sign up with us, you do sign a co-manufacturing agreement, but we've made it absolutely clear in that agreement that all the roles and responsibilities that are on your shoulders as an advice firm, we take control for, and it's documented and written into the agreement. So we take full responsibility of what you need to supply the regulator to ensure you're meeting those regulatory requirements. So coupled with the literature, the collateral, the investment committee, all of the due diligence that we supply you on the back of all of that part of the process, we believe that our service gives you the best opportunity of ensuring that you can take away and create efficiencies within your business by having an investment partner that provides you with all of the requirements that are required under co-manufacturing regulation. So we do the work, we provide you with all of what you need. All you need to do is put that work on file, save it in drives, and then use it if required, if the regulator was to come and knock in. That's my answer.
Thank you, Mark. In the interest of keeping to allotted time, I think we'll conclude the Q&A there. I think there are a couple of questions that have come through that obviously we've not had the opportunities to answer. Please be assured we'll make sure to come back to you individually with the answers you're looking for. So, recapping on the learning outcomes from today's session, you should now be able to identify the core reasons that a CIP may be holding your business back, assess the impact those reasons might be having on your business, and articulate how a tailored service could address those reasons. Similarly, you'll be able to discuss the differences between active and passive investing, and also describe the role and show the role these two ways of managing investments play in achieving greater diversification for your clients. Now, if there are any questions you didn't have the chance to submit or you prefer to contact us directly for, please be our guest and reach out to us using the details that are on screen now. This will each be on hand. I'm very, very happy to help you as best we can with whatever it is that you might need. So to conclude today's session, as we greatly value your opinions and your feedback on the content we've all walked through together today, once this broadcast ends, a form will automatically pop up for you, so please don't close the window, which we kindly ask you to complete, and at which point I'll then be in contact with your CPD certificates, as well as to book in a date to carry out a complimentary CIP review if you'd like one conducted. But all that's left for me to say on behalf of Mark, Gareth, myself, and the rest of us here at Blackfinch is just to thank you very much for choosing to spend your morning with us today. We hope you have a pleasant afternoon, and we look forward to speaking with you again very soon. Bye for now.